So now that we've learned a little bit about financial systems, and how that involves both financial markets and intermediaries, we've learned about savings and investment and how that affects the interest rate. Now it's time to move on to chapter 14, which is briefly about the basic tools of finance. So first things first, we talked about interest rate earlier on, but when let's say you go to a bank to deposit money because you want to save your money, right? You're going to earn interest rate on that deposit, right? But that interest rate is going to be accumulated over time, right? So let's say you want to leave that money in the bank for several years, right? So the interest rate is going to compound and accumulate over time. So you're going to end up earning more at the end of an extended period of time. And that is what we call a compound interest rate. So that leads us to the concept of present value and future value. Present value is saying in 2035, an amount of $20,000 is worth how much right now? So that is present value. So you're trying to discount from the future to the present. It's usually very useful when you're trying to make an investment and then you're like, okay, in the next 10 years, this investment is going to be worth this amount of money. So based on that future value of the money, then how much is it going to be worth right now? Is it worth investing in right now based on your estimated projection of its worth in the future, right? So that is called present value when you have to discount. So this is how you calculate your present value. So it's your principal divided by 1 plus your R. So your R is your interest rates. Raised to power n. N is your number of years. Okay? So number of years. So this is how you calculate present value, and that just means you are discounting your interest rates. So you are discounting a future value into the present. Okay? And it helps in making investment decisions. Okay, how about the future value? The future value is the opposite, right? The future value is your principal multiplied by 1 plus your interest rate raised to power n. So basically, what is a future value? Future value is, for instance, you are making a savings, right? A savings in your account, and you want to know, okay, I'm depositing $100 into the account right now. What is it going to be worth in the future, right? In the next 10 years, how much is $100 going to be, right? So let's take an example, right? So again, this example of $100, right? So let's assume we have $100 we're depositing in a bank to save, and let's assume that the interest rate that the bank is charging is 3%, right? So 3%, and let's assume we want to know how much it's going to be in the next 5 years. So basically, by the time you do your calculation, this is going to come up to $115.93, right? So this is at this interest rate. Now let's compare. How we got interest rate? This is 3%. So 3% divided by 100, that's how we got this, right? So how about if we have an interest rate versus an interest rate of 7%, right? 7%, 7 divided by 100, that's going to give you, right, this, right? And then in the same duration, what does that give you? That gives you a value of about 140.2. Right, 0.26. So therefore, you can see that having a higher interest rate is better for savings, right? So in terms of savings and trying to get the future value of the current money, it's actually better to have a higher interest rate, right? So higher interest rate is better for the future value, especially when it comes to savings. How about for the present value? So let's say you're trying to make a decision. You want to buy a plot of land, and that plot of land is valued at $120,000 in the next 10 years, right? And they are selling that plot of land right now for $70,000. So in that case, you have to discount the value of $120,000 in 10 years and try to see how much it's going to be worth right now. Is it actually worth it to buy that land for $70,000? So let's quickly do that, right? So you have $120,000, which is your principal. And let's assume again the interest rate is 3%, so 0.03, 3 divided by 100 in the next 10 years, right? This is going to give you about $89,000 and $291, roughly about this amount, right? So let's keep this money on one side. How about if we use an interest rate of 7%, right? Divided by 1.007 raised to power 10, that is going to give an even lower value of 61,000, roughly 61,000, okay? Now, can you see how with 3% interest rate, the value of $120,000 for the future comes down to $89,000? And the value of the land, remember that the value of the land is how much? $70,000. So that means this has a greater value right now, right? So if something is worth $89,000 and you're actually getting the plot of land for $70,000 now, that's a pretty good investment, right? So therefore, you should buy the land, right? Okay, but at this other choice of $61,000, if the plot of land, the current value of the plot of land is $61,000, then why are you buying it for $70,000? That's the wrong decision, okay? So this is how you use present value to make investment decisions, and future value gives you an idea of savings, right? In terms of saving for the long term. So that is a very important concept in chapter 14. The next one I want to talk about quickly is risk. So every investment involves taking risk, and there are three kinds of people when it comes to risk. So there is your risk lover. So your risk lover, as the name implies, they love taking risk. So you're going to have your utility on this side. So what does utility mean? Utility means satisfaction, and then you're going to have your wealth. In other words, your income, your wealth on this x-axis, right? Okay. So now, for a risk lover, they love taking risks. So the higher the money involved, the more they are to take a gamble, okay? The more they are to invest. So this is how the curve is going to look. It's an upward sloping curve, okay? So this is for a risk lover. How about a risk neutral person? A risk neutral person is indifferent between taking a risk or not. They really don't care, right? Okay. So for a risk neutral person, the curve is going to be a straight line, okay? So this is going to be a straight line for a risk neutral person. How about a risk averse person? So most people in life tend to be risk averse, meaning that they don't want to take risks. So if it's a risk that involves just $5, $10, they can gamble, they can party with $5, $10, they don't mind it. But they had the amounts involved, like when you're talking about $10,000, $1 million, people are less likely to take risks with such a huge sum of money, right? So those are risk averse people, and you guessed it right. So remember, at lower amounts of wealth, they are willing to take take a little bit of risk and get some satisfaction, right? So you see that it slopes upward first, and then they reach a point where it's like, hey, this is my limit. I can no longer take risks because the money involved is getting too much, and then it reaches a point where it starts sloping downwards, right? So in other words, when the money is too much, they are not interested in taking the risk, right? So these are risk averse people, okay? And that is that about risk lovers. I'm not going to ask too many questions on chapter 14, so you should be good.